If you're about to put your first dollar into the market, or even if you've already been investing for years, stop for a second. There are 7 red flags that quietly wreck people's finances before they even realize what happened. Not the obvious ones everyone already talks about, the ones that even experienced investors miss, because they don't look dangerous at first. They look like good advice. Today, we're covering the first 3. The remaining 4 are just as important, maybe even more dangerous, and I'm saving those for part 2. So stick around, because by the end of this video, you'll already be ahead of most people who call themselves investors. Let's get into it. Red flag number 1. Taking advice from someone who profits when you say yes. Here's something most beginners never think to ask. How is my advisor actually getting paid? A lot of brokers and advisors work on commission. That means the moment they recommend a product to you, they might be getting paid for that specific recommendation, regardless of whether it's actually the best move for your money. Some investment products pay significantly higher commissions than others, which quietly shapes what gets recommended to you in the first place. This isn't a conspiracy theory. It's simply how a large part of the industry has operated for decades, and most people never think to question it. The fix here is simple, but almost nobody actually does it. Ask directly. Ask how your advisor gets compensated. Ask if the product they're recommending pays them a higher commission than alternatives. If you get a vague answer, or if they seem uncomfortable with the question, that discomfort is information. A good advisor will answer that question clearly and without hesitation, because they have nothing to hide from you. The bigger principle here is this. Anyone who benefits financially from your decision is not automatically a bad actor, but they are also not automatically working purely in your interest. Those two things can be true at the same time, and the only way to protect yourself is to know exactly which one you're dealing with before you hand over your money. Red flag number 2. Investing before you have anything to fall back on. This one sounds boring, and that's exactly why so many people skip it. But financial advisors and platforms like Morningstar and NerdWallet consistently flag this as one of the single most common mistakes beginners make. Investing money that you might actually need next month. Here's why this matters so much. Emergencies don't check the market calendar before they happen. Your car breaks down, your job situation changes, a medical bill shows up out of nowhere, and if all your spare cash is tied up in investments, you're forced to sell. Not when the market is convenient for you, whenever the emergency hits, at whatever price is available that day, sometimes locking in a real loss just to cover something that had nothing to do with investing at all. The standard recommendation you'll hear from almost every serious financial planner is to build 3 to 6 months of essential expenses into a high-yield savings account before you invest a single dollar into the market. I know that's not exciting. Nobody makes a viral video about their emergency fund. But that boring safety net is the exact thing that keeps your portfolio invested and growing, instead of getting liquidated the moment life happens. Because life always happens eventually. Think of it this way. Your emergency fund isn't separate from your investing strategy. It is your investing strategy. The part that makes everything else actually work without falling apart the first time something goes wrong. Red flag number 3. Investing because everyone online is suddenly talking about it. This is the one that costs people the most money the fastest. And it's only gotten more dangerous with how connected everyone is now. You see a stock, a coin, some new trending asset, exploding across social media. Everyone's posting screenshots of their gains. The comments are full of people saying they wish they'd bought in earlier. And that feeling creeps in, the one that says, if I don't act right now, I'm going to miss this completely. That feeling has a name, fear of missing out. And it is, without exaggeration, one of the most consistently destructive forces in investing history, because it bypasses your actual judgment and replaces it with urgency. Here's the pattern almost every time. Beginners see the hype, jump in without understanding what they're actually buying or why it's supposedly valuable. And by the time they bought in, a huge portion of the real gains have already happened. What's left is often the most volatile, most dangerous part of that asset's entire price movement, right before it drops. The uncomfortable truth is this. If you can't clearly explain what a company does, how it actually makes money, and why you believe it's worth more than its current price, you're not investing. You're speculating. And speculating based on social media hype is one of the fastest ways to turn real money into a very expensive lesson. A useful test before you buy anything trending. If the same opportunity existed quietly, with zero hype, with nobody posting about it, would you still want to buy it based purely on the fundamentals? If the honest answer is no, that hype is doing all the convincing, not the actual investment. So that's 3 down. 3 red flags are already costing regular investors real money right now, today, while they think they're just being smart with their finances. But there are 4 more coming in part 2, and honestly, some of them are even more dangerous than these first 3, because they're even easier to miss. Subscribe now so you don't miss it, and I'll see you in the next video.